Hello, welcome back to this week's market update. Today is Monday, August 5th, 2024, and it was a very busy week last week, as well as a very busy morning today. So we will jump right in. Before we head into last week's news, I wanted to touch base on this morning's market update, and that is just that major indexes continue to sell off here in the 3 to 5% range just as of this morning, and the VIX has skyrocketed quite a bit to actually the highest level since 2020 here during the pandemic. So there's a lot of volatility in the market right now. There is quite a bit of negative momentum since last Thursday, and we are keeping an eye on it very closely. So right now we do kind of view this as a short-term bump in the road following that weak jobs report on Friday, but we wanted to just keep you updated, keep you posted, and let you know we are monitoring the situation very closely. Shifting gears into last week's market news, stocks sold off last week as recession concerns intensified following a weak July employment report and other bearish indicators, as well as the absence of a very definitive timeline for rate cuts from the Fed during their meeting on Wednesday. As of close on Friday, August 2nd, the Nasdaq Composite fell more than 3%, the S&P 500 and the Dow both fell about 2% last week, and then bonds were up as yields fell, with the Barclays Agg up about 2% on the week. Last week on Wednesday afternoon, the July FOMC meeting took place where Fed Chair Jerome Powell announced no policy changes but indirectly suggested that a September rate cut could be appropriate. He did, however, not give any very clear guidelines of what would have to happen for the September rate cut to be appropriate. He also did not mention how much of a rate cut could be appropriate either. So overall, not a very eventful Fed meeting, although they are always important to keep an eye on as they can be significant developments for the market. But it really was a very neutral Fed meeting. The market did rally after the meeting, up about 1 to 2% on Wednesday last week. And the probabilities for rate cuts ahead shifted from pricing in one rate cut. You can see here in the 1 week ago probability that was almost certainly pricing in a 25 basis point rate cut in the September meeting. Now the market is pricing in 2 rate cuts, and this is as of Friday, so it might have even changed even more so as of this morning with that negative momentum behind the market. So overall, not too much of an update from this month's Fed meeting, but we do want to keep an eye on this as we look at economic data and see what the Fed might be thinking about the pace and the amount of rate cuts ahead. Perhaps the largest update of last week and the biggest catalyst of the negative momentum we're seeing in the market today was the July unemployment rate coming out on Friday last week. So that unexpectedly ticked up to 4.3% for the month of July, while non-farm payrolls came in at just 114,000 new jobs compared to the 170,000 that were expected. Average hourly earnings rose modestly, about 0.2% in the month, which was up 3.6% from a year ago. Although this is just 1 month of weak data, it could be an early sign that the US might be past due for a less aggressive stance of quantitative tightening. So the market is really concerned that we are creeping towards that recession as there are lags in monetary policy. So if the Fed cuts too late into this cycle, we could unintentionally go into a recession. However, again, this is just 1 month of bumpy data, but it is causing a lot of turmoil on Friday and even into this week. So we'll continue to monitor the labor market for these sorts of data points and keep you posted. Moving along through our week, we also got the Consumer Confidence Index from the Conference Board, showing July's consumer confidence ticking up slightly from June, as expected, to 100.3 in the month. In the survey, consumers remained concerned about high prices, interest rates, and economic uncertainty. We also saw consumers under the age of 35 and over the age of 55 show increased confidence, while those in the 35 to 54 age group saw a decline in confidence. By income level, higher income consumers remain the most confident in current economic conditions, and we also saw that inflation expectations stayed relatively stable in the month. Finally, the share of consumers expecting higher interest rates ahead fell to just about 50%, as more consumers become aware of potential rate cuts ahead from the Fed. When we look at the longer term trend of consumer confidence, really since this post pandemic pop, it has been trending down, so that's not a great sign from consumers. Maybe this is when they got a fair bit of stimulus money. They were starting to get jobs again in early 2021. The unemployment rate was falling sharply. And ever since then, consumer confidence has fallen off. So, just interesting stuff as we take a comprehensive view of the economy, especially things like the consumer and how that plays into portfolios and just our overall view of the market. Also, last week we got the ISM Manufacturing Index for the month of July. It unexpectedly fell to 46.8 here, which was quite a bit of a drop from last month's 48.5. And it also marked the fourth consecutive month of contraction in the manufacturing sector since this 1 month of just ever so slightly positive data in March here. It does continue the downward trend that we've been seeing in the manufacturing sector of contraction, and really notable in July's report, every one of the six largest manufacturing industries, such as machinery, transportation equipment, metal products, food and beverage products, chemical products, computer and electronic products, all of those categories contracted in the month. So that's quite important there to take note of. It also coincides with the weaker labor market data as well as just the overall slowing down of the economy, like the GDP report that we got about 2 weeks ago. We will continue to keep an eye on the ISM indexes here as we get the services index this week, but this does continue to be a bearish indicator on our recession dashboard, which we will take a look at next year. So, in the past week or two, we've heard a lot more talk about a possible recession ahead. A lot of clients concerned about, are we going to get a recession? When is it coming? And ultimately, only time will tell. But we do have this handy dandy recession indicator dashboard that gives us a good idea of 8 fairly accurate indicators, although not perfect. No indicator is perfect, but they are typically quite helpful indicators of current economic conditions. So you can see that this one recently turned bearish, the ADS, that is a high frequency business conditions index. And we also had the ISM manufacturing index continue to be bearish, even more bearish than it was a month ago. Overall, we have 4 bearish indicators here. We have 3 bullish and 1 neutral. So that does make this stance, according to this dashboard here, slightly more bearish than we are bullish, but again, still mixed, still waiting to get more data and see how the economy unfolds in the coming months and as the Fed starts to cut rates. That concludes this week's market update. We appreciate you tuning in each week, and we look forward to providing another update for you very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.